Hi there, welcome to kneppyinvests. I've subtly changed some of my investing philosophies over the past few weeks, and instead of focusing mostly on my long-term buy and hold portfolio, I'm starting to focus more on my short-term sentiment portfolio. And one of the reasons I'm doing that is simply because the state of the markets right now and the likely returns we'll see in the next 5 to 10 years. And in fact, the likely returns for our buy and hold portfolio is actually quite low. So I do think we're heading into a stock picking environment. And when I'm talking about a stock picking, I'm more referring to those sort of companies that will go on a run for over a medium to short period of time and then just go sideways or even down after that. And in those sort of situations, the long-term buy and hold philosophy won't significantly outperform the market. I do think a stock picking short to medium term sort of philosophy will significantly outperform the market in the next 5 to 10 years. And that's why I'm slightly adjusting my investing philosophy and paying much closer attention to announcements that are being released by companies, in particular very positive announcements that could drive the share price higher over that short to medium term. So in this video, what I'm going to do is look at 3 hot companies that have released announcements over the past few days, and we have seen the market react to those announcements. And then I'm going to look at 2 companies that have seen the share price take a fairly big hit in recent times. And in fact, for one company, it's over the past 6 months. And I'll be talking about why these companies' share price have been under pressure in recent times. The 5 companies I'll be featuring in this particular video are Magellan Financial Group, Metcash, Booktopia, Revasum, and Neuren Pharmaceuticals. Funny enough, I actually was a shareholder of Neuren Pharmaceuticals about 8 years ago because I saw the potential of what they were doing, but I was a little bit too early to the party. But finally, they have released an announcement that has got me excited. And I'll talk about that company at the end of this video. But the first company we'll be talking about in this video is Revasum. This is a company I held recently and then sold because the share price had gone on a really significant run. And then on the 7th of December, the share price rose 33% on the back of a presentation that the CEO, Rebecca Dodd, gave at the 10th Annual December CEO Summit. I went through this presentation, and it was an impressive presentation, but it was towards the end of the presentation that got me significantly interested in this company again, and I think why the market absolutely loved this presentation and why the share price rose 33% in the one day. Towards the end of the presentation, Revasum gave some revenue forecasts for financial year 22, and they are expecting significant growth from financial year 21 to financial year 22. It does seem like there's a lot of tailwinds behind this company, and the CEO, Rebecca Dodd, talks about those tailwinds in this presentation. So Revasum is all about semiconductor grinding technology, and this is a growth area, but they are forecasting revenue to grow between 60 and 125% year on year from financial year 21 to financial year 22. And if they do hit that, that would be significant growth and be confirmation that this company is a significantly growing company. And this will be significant, again, that word significant, for this company because you can just see through this revenue table that they did provide in the presentation, revenue has been dropping over the past few years. So this would be return to growth for this company. So it does look like one of the reasons why we did see the share price run up in the past few months for Revasum was because the market was getting excited about this potential growth in revenue over the next few years. And I think as soon as the market saw this, this was confirmation to the market that the management of Revasum is seeing the same thing, that there will be significant growth in revenue for this company. Now the question is, can they convert the growth of revenue into cash flow? Or potentially this growth in revenue will go to research and development for future growth in the next 5 to 10 years. But this is exciting times for this company, and the reason why the share price rose 33% in the one day. This is the daily chart for Revasum going back to the start of the year, and from the start of the year to around October, the share price was going sideways. I did take a position in Revasum in June when the share price was around 27 cents, and then we saw a lot of excitement come into the share price in October. In fact, the share price rose from 40 cents to a high of 87.5 cents. And then we just saw a bit of a correction from that high to the day before they released this presentation. In fact, the share price fell from that 87.5 high all the way back to 42.5 cents. And then on the back of this presentation, the share price rebounded to 58.5. Now, just looking at this daily chart, there is going to be a little bit of resistance moving forward for Revasum because there would be a fair few shareholders who bought higher than 58.5 cents during the past few months. And immediately, a lot of those shareholders will be thinking Revasum is a dog stock because the thinking among a lot of investors right now, particularly new retail investors, is if the share price falls from when they bought in, the stock or the company automatically becomes a dog stock and they just need to sell out. So it's going to be interesting to see how the share price reacts over the next few weeks. If the share price doesn't suffer too much, doesn't pull back too much, if we see the share price consolidate and go sideways on pretty good volume, that could be a good sign that the share price of Revasum is trying to move into a long-term sustainable uptrend. And that's when I might take another position in this company, particularly because of their revenue forecast for financial year 22. Onto a company that has seen the share price drop a fair bit over the past 6 months or so. Now, it's quite interesting because during the COVID-19 financial panic, Magellan share price got down to about $30, and I do know a lot of investors were so excited that they were able to buy this fund manager at such low prices. But right now, the share price, well, on the 7th of December, the share price has actually fallen below those COVID-19 financial panic lows. And one of the reasons why the share price did fall about 5 or 6% on the 6th of December, 6.37% on the 6th of December, is they have announced that the CEO, Dr. Brett Cairns, has retired from his position. And whenever a CEO does leave a company, particularly if it's unexpected, you will see some investors get quite nervous about that, because it does actually increase the risk moving forward for that company, because we don't know who the new CEO is going to be. It could be a significantly worse CEO, more than likely won't be, but there is that chance, a very small chance. So because there's an increase in risk, and a lot of investors or the investing community doesn't like risk, they want certainty. And that's why we did see the share price of Magellan fall 6.3% on the 7th of December. And this just reinforces the downtrend that Magellan has been in for the last 6 months. And this is the daily chart for Magellan going back to just prior to the COVID-19 financial panic. And just prior to the panic, the share price of Magellan was $74. And then the share price fell all the way down to $30 during the panic. And that's when a lot of people became excited about this fund because they could buy in at much cheaper prices. Sort of a recency bias. I wouldn't call it a problem, but you do see this a lot. When people see the share price that it is or could be right now, $30 at the bottom of the COVID-19 financial panic, and they compare it to what the share price was a few months previous to that, they think, well, there's really good value here. Sometimes that is true, but sometimes it's not true. There could be a reason why the share price has fallen significantly. And then we did see, just like a lot of other companies on the ASX around the world, a V-shaped recovery in the share price. In fact, the share price improved to about $66 in August of last year. But since that rebound, the share price has been under pressure. In fact, the share price from August, or the release of their full year results this year, has been under significant pressure. Just before they released those full year results, the share price was around $50 to $52, and it's fallen all the way from that $50 to $52 range to a current share price of $29.10, which is now lower than the lows during the COVID-19 financial panic. And since the share price went through that good support level on significant volume, and if you do look at the volume here, which is on the bottom, it is actually the highest volume we have seen in one day over the past 2 years. And that shows you that the investors, in regards to this resignation of the CEO, are a little bit more nervous about this company. And for the fact that the share price has been in a well-defined downtrend since August, probably just reinforces the nervousness of these investors and the holders. And right now, because the share price just zoomed through that good support level, with some probably quite prudent just to remain patient here, just to see how the market reacts to Magellan over the next few months, and maybe even wait to see who the new CEO will be in who knows when that's going to be announced. Next company I want to look at is Metcash. They released their half-year results for financial year 22 on the 6th of December. And the market did like these results because the share price rose 29 cents or 7.34%. And when we look at the chart, you'll see that the share price is now at long-term highs, not historical highs, but long-term highs. So the share price is in an uptrend, and there is positive sentiment behind this company. And when a company does release either half-year or full-year results, the market reaction doesn't necessarily mean that the results were good. It could be that the results beat expectations. So sometimes you will see results actually be worse than the previous year, yet the share price will go up. Or you might see results significantly improve from the previous year, say profit up 30-40%, yet the share price falls by 10%. And it's all based off expectations. If results beat expectations, more than likely the share price will go up. But if results don't beat expectations, more than likely the share price will decrease. And the other thing you have to take into account is whether the company gives any guidance for the rest of the year. And if they do upgrade guidance, that could mean the share price takes there is a bit of an increase to the share price. Or if there is a bit of a decrease to guidance, that's when the share price could take a bit of a hit. So let's get stuck into Metcash. We'll just have a look at their financial results for the half year. If you don't know what Metcash does, they own some supermarkets, IGA, I think it's called Drake. They also have liquor stores and hardware stores. So they have three sort of verticals or segments here, and they do break down the performance of each segment. You can see that on the bottom here. For instance, their supermarkets actually fell in terms of revenue from 4.8 billion to 4.6 billion, but their liquor stores and the hardware stores both rose. In fact, the hardware stores rose by 18% in the past year and have risen 42% in the past 2 years. So it seems like their hardware division is going gangbusters right now. Even their liquor division has risen 22% in terms of revenue over the past 2 years, while the supermarkets have only risen by 4%. So group revenue was only up 1.5% to 8.2 billion. Group EBIT up 13.9%, UPAT up 13.1%, underlying EPS up 15%, interim dividend up 31%, and operating cash flow 212 million. You notice they haven't put an increase there because actually operating cash flow fell for the year, down from about 300 million to 212. So this just shows you, look at any presentation a company shows or gives us, because they will manipulate presentation slides to suit themselves. And that's why in the operating cash flow bit, there's no increase or decrease shown, because actually operating cash flow decreased during the past year. Now, I don't know what the expectations were for Metcash leading into the half-year results, but if the share price did increase 7%, we either know that the results beat expectations or the company's outlook is quite bullish. So this is their outlook for the group, and there is a little bit of bullishness here and some bearishness, some risks also mentioned in their outlook. They initially have mentioned that their strong sales for the group have continued in the first 5 weeks of the second half of 22, buoyed by the shifting consumer behaviour, improved retail competitiveness. The food and liquor pillars are expected to benefit from a strong Christmas New Year's trading period. So a little bit of bullishness in both of those first two comments. But they've also mentioned supply chain disruptions, including increasing labour and COVID-related costs that could be a risk for all their pillars, so that's all their verticals, in the second half. They also talk about additional investment in the second half to accelerate online shopping rollout. So they're spending $4 million in that. Continued uncertainty over the potential impact of any future COVID-related trading transactions. And the financial year 22 will include a 53rd week of trading in all pillars. So that one extra week will increase the results slightly, maybe not slightly, but it will have a significant impact on the results. And it's good that they do mention that. So a little bit of bullishness in the outlook, a little bit of uncertainty there, a little bit of risk as well. So a good broad amount of possibilities when it comes to Metcash over the next 6 months. Instead of looking at the daily chart for Metcash, this is a sort of company where you want to look at the longer term. And this is the weekly chart going back to 2008 when the share price was between about $4 and $4.80. You can see share price going sideways from 2008 all the way to 2013. And then for some reason, the market absolutely hated Metcash during 2014 and 2015. In fact, the share price fell all the way to $1 in 2015. And then we saw a pretty good recovery, and that recovery has continued over the past 6 years. And right now, the share price of Metcash is in a well-defined uptrend. And in fact, the last time we saw the share price this high at $4.32 was way back in 2011. So a 10-year high for the share price of Metcash. So not a lot of resistance moving forward for this company and a lot of positive sentiment behind this company. But sometimes you might say, because the share price is at a 10-year high, and even though we do see a bit of an increase in some of their financial metrics, revenue still more than likely won't grow all that much unless we continue to see hardware division grow at really good rates, so 42% over the past 2 years. But the food division, the supermarket division, has only grown at 4% in the past 2 years. So right now, a lot of positive sentiment behind this company, but my biggest question about Metcash is just how high the share price can rise from here. Booktopia is a company that listed on the ASX towards the end of 2020. And even though I haven't done a lot of research on this company, I am becoming a little bit more interested because the share price has taken a fair bit of a hit in the past few months. So as the share price falls and falls, I'll wait for a period of consolidation, blah, blah, blah. And if we do see some good financial news from the company, that's when I'll take a position. But we'll have a look at the chart in the next slide. However, the share price has been under significant pressure in the past week. We have seen the share price fall quite a bit. And we did see the CEO of the company, Tony Nash, sell some of his shares. In fact, he sold 3.5 million of his shares to one of the company's large institutional shareholders. And a lot of times you will see investors get nervous, just like when a CEO resigns, when a CEO sells some of his shares. And a lot of investors think automatically that means the company is not doing well. The CEO sees something and he wants to take out his cash. But he still has 19.34 million shares, or 14% of Booktopia's issued capital. And the saying goes, insiders of a company will sell for many reasons, but they only buy for one reason. So why has Tony Nash sold 3.5 million shares of Booktopia? Well, it all comes back apparently to the lack of liquidity in the company. So they mention here that there has been strong interest from institutional shareholders wishing to purchase substantial stakes in the company. However, or unfortunately, there is very little liquidity to allow these large institutional shareholders to take significant positions. And that's why he decided to sell 3.5 million shares to one of those large institutional shareholders. Well, it seems like the market and the shareholders don't like that. They want to see the CEO maintain his holding because that shows them that he has a lot more confidence in the future of this company. And I think the other thing is he sold his shares when the share price was under significant pressure. But again, I'll go back to the very fact that it doesn't mean that Booktopia is not performing financially. It doesn't mean that at all. But still, it's not a good look when the share price is decreasing that he decides to sell some of his shares. Booktopia listed towards the end of 2020, and this is the chart, daily chart since then, and the share price was just sort of going sideways up until August or early September of this year. You could have bought Booktopia between about $2.40 and $3 during that period, but we did see the share price starting to fall in September and the start of October. In fact, the share price fell from $3 all the way down to $2.50 over about a 2-month period. But we started to see acceleration in the dropping of the share price of the company, and that's really accelerated over the past week. In fact, the share price has fallen from $2.25 to a current share price of $1.75. So I think there is a few shareholders thinking, why is the CEO selling as the share price of this company falls? He should be doing the exact opposite. He should be showing that there is value right now in Booktopia, actually buying more shares. So there is not mixed messaging, but I just think there is a bit of confusion why the CEO is selling as the share price keeps on dropping. He should be doing the opposite. But I do understand where Tony Nash might be coming from. He thinks, well, there needs to be more liquidity in Booktopia's trading, and to do that, he sold a lot of his shares to an institutional shareholder. And that institutional shareholder might then sell all their shares, and that just increases the liquidity. But I am of the opinion that the best time to sell shares is when the share price is at its highest. That's when you sell shares. That's when you do a capital raising. And the fact that he's selling shares as the share price decreases and is at a low, all-time low for the company, is not the best of looks and is not the best strategy for a CEO. Final company for this video is Neuren Pharmaceuticals. This is a company I held 9 years ago, or maybe 8 years ago, and the main reason I held Neuren Pharmaceuticals back then was because of the potential I saw in some of their drugs, in particular their Rett syndrome. It's only taken 8 years before we are potentially seeing a financial windfall for Neuren Pharmaceuticals. They released an announcement on the 7th of December titled Positive Top-Line Results from Pivotal Phase 3 Trial in Rett Syndrome, and the market absolutely loved this announcement. Share price rose $1.55, or almost 100% rise in the share price. In fact, at one point in time, it was over 100% rise, but it finished at 91.2% rise. And I'll show you why I think the market was excited about this announcement and why I'm excited about this announcement. They also mentioned that Acadia, which is their partner in regards to the trial of Rett syndrome, I think Acadia pays for all the spending for the trials, plans pre-new drug application meeting with the FDA in Q1 2022 and new drug application NDA around mid-year 2022. Because this is an orphan drug, there is potential we might see some fast track of this Rett syndrome drug being approved, and then we might see, or probably will see, a fair bit of cash flow coming into this company. Why did the market, and why am I excited about this announcement? Well, there were some financial numbers within the commentary of this announcement. So it just mentions here that the development and commercialization of the drug in North America is fully funded by Acadia, and Neuren is eligible to receive potential milestone payments of up to $455 million plus tiered escalating double-digit percentage royalties on net sales of the drug in North America, plus 1/3 of the market value of a rare pediatric disease priority review voucher if awarded by the FDA on approval of a new drug application for the drug. And Neuren would earn revenue over 2022 and 2023 in the US alone of 111 Australian dollars plus double-digit percentage royalties on net sales if a new drug application is approved by the FDA and the drug is launched in the US, and that that assumption is based on exchange rate, and that Neuren receives $32 million as its share of the market value of a rare pediatric drug. So the very fact that they have included some financial numbers in the announcement is why the market is getting excited. And if everything goes well for Neuren, we are going to see this company flush with cash over the next 3 or 4 years. And that's a really good reason to get excited about a company who has a market cap of less than $500 million. So these numbers alone should suggest the market cap of this company should be much more than it is right now. Now onto the weekly chart for Neuren, going all the way back to 2012. I got excited about this company in 2013, and I was really excited about the potential of their drug in regards to the Rett syndrome. Now you can just see Neuren's share price has oscillated between about $1 and $3.60. Now, when I had a position in this company, it was about 14 cents, but they did do a share consolidation. I'm not sure exactly when. So even though I was holding shares when the share price was about $1.40, if it was a 10-for-1 share consolidation, that equates to a share price of $1.40. But whenever the share price gets down to about $1, that's a good time to buy some shares in this company. And when the share price gets to about $3.60, that's a good time to sell. We've seen that time and time again over the past 8 years. And on trading on the 7th of December, the share price actually went to the resistance level at about $3.60, and then we saw selling, and the share price pulled back to $3.25. If the share price moves above $3.60, gets to an all-time high, that would be a bullish move for this company. So even though the share price has been at these levels in the past, I'm way more bullish about this company moving forward because of the potential cash flow into this company over the next 5 years. That's all I have for this video, talking about 3 hot companies or stocks: Revasum, Metcash, and Neuren Pharmaceuticals. Potential buys for all 3 companies. Exciting futures, particularly for, in my opinion, for Revasum and Neuren Pharmaceuticals, while Metcash share price is in a well-defined uptrend and lots of positive sentiment behind that company. And also talking about 2 cold stocks. Magellan Financial share price is now lower than it was during the COVID-19 financial panic. And the further it drops, the more excited, more interesting I would find that company. While Booktopia CEO has sold out some shares, and the market has reacted very negatively to the selling of those shares, and we have seen the share price take a massive hit over the past few weeks, in particular in the past week. If you have any opinions, any thoughts about these companies I featured in this video, I'd love to hear your thoughts. Or if you have an opinion about any other company on the ASX, please leave a comment or a question in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.